Live from Bloomberg's world headquarters in New York City, we're tracking the key players, the major moves, and the capital flows shaping global markets. This is Bloomberg Deals.
Welcome to yet another episode of Bloomberg Deals, the only show dedicated to the corporate action shaping markets. On today's show, you heard it first. From our Bloomberg Deals team, Warner Brothers agrees to reopen negotiations with Paramount. That starts the clock again in what has been a thriller of deals talks. Plus, game on, MSG unveils another possible change. This time, its board explores a possible spinoff that would separate the Knicks and Rangers. And in a few moments, my exclusive conversation with John Winkelried, the CEO of TPG, which manages more than $300 billion. He discusses software, AI, disruption, and then certainty around IPOs. But first, let's bring in the reporters behind the headlines for today's big deals. I'm joined today by Bloomberg Sports business reporter Randall Williams and, of course, Bloomberg Deals reporter Michelle Davis, because you know, if we have a Warner Brothers Discovery story, the woman who broke it was Michelle. Michelle, welcome back. This is a weekly occurrence. I think we have to accept that fate now. So what is the latest in Warner Brothers?
So to recap, the moment we've all been waiting for, the whole will they or won't they, Warner Brothers agreed to finally engage with Paramount. And I have to give a shout out to my colleague Lucas Shaw, who also broke this news with me. And I think the most interesting thing right now is that even though these two sides are engaging and they have 7 days to do that, Warner Brothers gave Paramount until Monday at midnight to basically put down its best and final offer, clarify anything in the deal docs. But it still seems like there's some skepticism or acrimony between the two. Paramount yesterday, in a press release acknowledging this, time period where they're going to be able to negotiate, said, Warner Brothers only gave us a limited amount of time. They said, despite that, we're still going to engage, but they wish they would have had more time to negotiate. So it's interesting because the two sides are putting each other at arm's length, but we'll see if they can finally agree to some sort of better deal than what Netflix has on the table.
Sounds like a lot of excuses. It sounds like I did bad at the gym because I was tired or whatever, setting yourself up for that. What would it take for Paramount to be the winning suitor? What do they need to bring to the negotiating table?
So they'll have to raise their offer, and what Warner Brothers really wants is for Paramount to basically adopt the merger agreement that Netflix has already agreed to, which is pretty permissive in terms of allowing Warner Brothers to operate in the interim between signing and closing. And so if Paramount were to just do that, the Warner Brothers board would probably be receptive to that, but it's going to take a higher price as well. Once they do, if they do raise their offer price beyond 30 or 31, which is what they suggested they might be willing to go past, if the board determines that it's superior, then Netflix will have a chance to match that, 4 days to match it. And if they do match or tie, they win. So a lot could happen from here.
Yeah, the clock is certainly ticking down. That's one potential deal. Another potential deal, Randall, which you're tracking this morning, is Madison Square Garden Sports contemplating spinning off the Knicks and the Rangers business. Why would they do that? Why are they even considering it?
What they said in the press release was that they wanted to get a proper valuation on both of these assets. Both Madison Square Garden Sports is valued at $7 billion on the open market, but the Knicks and the Rangers have to be at least twice that. If they were to be sold tomorrow, I think the Knicks would probably trade for over $10 billion. I think the Rangers probably closer to $4 billion. These are New York sports teams that play in arguably the most famous arena in the entire world. It's hard to believe that $7 billion would be the number, especially when the Lakers just traded at 10.
It's a very good point. Can you explain, just on that note, the business of MSG? I feel like it's a complicated beast, and it's already gone through a lot of transformations before,
well,
right?
Listen, how long do we have?
Let's Can you do that in 30 seconds? No.
I think, look, MSG Sports is comprised of now the Knicks and the Rangers. They're going to split. Outside of that, you have MSG, the building. You have Sphere Corp, which is outside of MSG altogether. There are it feels like a dozen different departments and sectors of MSG Sports. The Knicks and the Rangers will now be two different ones.
All right, well, I guess it at least is continuing on the theme of corporate carve-outs. We've seen a lot of that. So good for MSG. Randall, thank you so much. Michelle, you as well. Let's now turn to our in-house Rangers superfan, Scarlett Fu. I'm going to be honest, she's not talking about hockey. We will get to that later, because I know you have opinions, Scarlett. You're looking at activist investors on the hunt this week.
That's right, and it's because it's proxy season, which is that time of year when public companies hold their annual meetings and distribute proxy statements to shareholders, which means activist investors are often launching or intensifying their campaigns. Let's start with Wendy's. This stock is jumping after its biggest shareholder, Nelson Peltz's Trian, said it's in talks with potential lenders, co-investors, as well as strategic partners on potential deals involving the burger chain. Next, you've got JANA Partners, now a shareholder in Fiserv. pushing for changes after CEO Mike Lyons' efforts to revamp the payments processor left investors kind of underwhelmed. Pfizer stock is down more than 70% over the past year. We also learned that Elliott Investment built a 10% plus stake in Norwegian Cruise Lines. The activist investor working with a former senior executive of Royal Caribbean, the rival, as one potential board nominee at Norwegian. And staying with travel, Starboard Value sent a letter to TripAdvisor announcing plans to nominate a majority slate of director candidates for the 2026 annual meeting. And that's just in the last 2 days, Danny.
Yeah, it can only get busier from here. So that is a lot. Scarlett, thank you so much. And another activist story with Starboard that we're following comes from a Bloomberg News scoop. We learned that Starboard is asking Riot Platforms to speed up its transition from a Bitcoin miner to a data center company. It's a playbook others like Galaxy Digital are already employing. CEO Mike Novogratz recently discussed that on Bloomberg Crypto.
We have this data center business, which is booming. Thank God. Like, you know, if I didn't have the data center business, I'd feel a lot worse. But our data center business is now, you know, worth more than our crypto business.
Let's get more into the story with Starboard urging Riot to speed up its transition to a data center company. For more, we go to Bloomberg Digital Assets reporter Lauren Tara-Lacapra. Lauren, why? Why would Starboard push Riot to do this?
They want to see Riot get moving, right? They want to see them do what others are doing. I mean, Riot has been moving into the AI data center space already, but it's competitive, and there's a lot of others doing it. You want to get those hyperscalers in. You want to be able to transition these centers into something new, and there's different technology and different equipment that's needed. So
I get why that area is hot because of AI data centers. That makes sense. But is there something that's changed with Bitcoin mining that specifically makes that less appealing right now?
Oh, absolutely. So, you know, the price of Bitcoin has gone down quite a bit, at least since October, and the profitability of the miners has just plummeted. So it's becoming an unsustainable business model. They have to be able to make money from the Bitcoin that they're mining. At the same time, they can make money from the AI data center. You know, so the trade-off is there.
What about consolidation? Starboard also pushing Riot, says it could be a good candidate for something like that. Have we seen a lot of M&A in this space?
We haven't seen very much M&A, but there's a lot of talk about it. In the miners, as well as the DATs, like there's parts of the crypto industry that are just ripe for consolidation. It's just a question of when that's going to happen.
Thank you so much for bringing us that story. Looking forward to your weekly contributions on Bloomberg Crypto too. That is Bloomberg's Lauren Tara-Lacapra. Coming up on Bloomberg Deals, John Winkelried, the TPG CEO, on what the latest AI shock means for the future of IPOs. Stay with us on Bloomberg Deals. Time now for the big picture. At the start of the year, TPG CEO made a prediction. We were heading into 2026 with substantial uncertainty. That prediction has been playing out in a major way as markets punish private capital on AI disruption fears, specifically their publicly listed stocks. John Winkelried, the CEO of TPG, spoke on the $300 billion manager strategy to navigate the turmoil.
There's a big curveball here starting the year out. I don't think anybody anticipated a reset of this magnitude in terms of what's going on now in the market, and so what does it mean for the rest of the year? First of all, I think that when something like this happens, there's a reset of this magnitude. I think that everybody takes stock of what's happening in the portfolio. Where should we be focused? Where do we need to really direct our attention in order to manage through a period of uncertainty like this? And one of the things that we're doing as a firm is, when we have something like this happen, we pull people together, and many of us have been through experiences like this before, where you have shocks to the system, you have a lot of volatility, and as a result of that, you need to pull people together, and you need to help people understand what to focus on, right? So we're doing that actively at TPG, where we're getting people together and we're saying, let's focus on the portfolio, let's evaluate what's happening here, what's the impact of what's happened. Let's not take our eye off the ball with respect to where there are opportunities, because I think one of the things that we feel always happens where you have a significant jolt to the market like this is it always creates opportunity. And we can talk about that some more.
What does that opportunity look like?
Well, opportunity in the context of valuations are going through a substantial reset. We fundamentally believe that there are going to be really good companies that are misvalued as a result of this. So that's one, obvious opportunity. Another opportunity that, we're in the midst of right now as a result of, since AI obviously is a very, very important focus of what's going on now, is that, for some period of time now, based upon how we invest, what our sector expertise is, we've been very focused on how do we accelerate the growth of our companies as a result of AI. And I think one of the things that we've done at the firm is I asked one of our senior people to really lead an AI task force, which got put in place at the end of last year. And one of the functions of that task force is really to develop discipline on best practices throughout our various private equity strategies on how do we use AI to be an accelerant of growth within our portfolio.
How do you figure that out? Because it is brand new. It's not like this is a field that people have been studying for decades and you can bring in someone with gray hair who's been doing it forever. Well, how do you crack that nut when it's just a new territory?
Yeah, well, first of all, I think even though AI, it feels relatively new in terms of the phenomena of OpenAI or a number of these big companies that have now, developed these powerful models. We've been investing in the earlier stages of AI at TPG for a while. So it's not like this is absolutely new to us. I mean, we've seen this coming for quite a while, that there are going to be smarter models, there's going to be improvements in technology, and as a result of that, we have invested behind some of these themes now for a while.
Can I ask, so that's the story happening at TPG. If I were to just zoom out, one of the big impacts we have seen from upheaval in public markets has been, we've seen two big IPOs in the past couple of weeks delayed, one in Clear Street, one in Liftoff, a private equity-backed company itself. What happens to the IPO market? Can 2026 be the year that IPOs come rushing back if you have this kind of volatility in public markets?
I think that it's going to be a tale of several cities, okay? I think that there's no question that the market shock that we're going through right now is going to curtail a certain amount of public offering activity, IPO activity. There's no question that the shock that we're going through right now is going to cause, in certain cases, companies that sponsors might have thought about selling to hold back because there's just too much uncertainty to bring a company to market, right? So you're going to do what's rational in this environment with respect to, do we feel it's a good time to actually try to monetize, to sell a company?
What's going to be the dividing line between which companies you can and which you can't?
Sector differences, the underlying strength of a business because, it's in a part of the market that is really not being impacted by this. I mean, across, our business is healthcare, our PE business is healthcare, internet, digital media, consumer, some business services companies, and software. That's our, right? There's a number of sectors in there. There's a number of companies in our portfolio that we think are incredibly fabulous companies. They may be ready to get monetized. If they do, we will, we'll think about monetizing them. Just so you know, the way we think about it as well is that if you look at our history and our franchise, we like to create multiple paths of exit for our companies. We're well known for doing deals in partnership with corporates. Mm-hmm. We're well known for corporate carve-outs. Most of our exits are to strategic buyers. Most of our exits are through non-IPO, ultimately non-IPO exits.
Can I just ask, implicit in this, does this mean that others in the industry haven't set themselves up in the same way? That there are those who are too reliant on IPOs? Well,
if you look at the history, if you look at the facts, that's absolutely the case. Different firms have different approaches and different strategies in terms of where they focus their investing energy and also how they set up their portfolios in terms of how they want to exit. So in the U.S., as an example, there are very few exits. There are very few of our exits that are through the IPO market. Occasionally, we do them, but most of them are set up so that we're focusing on strategic buyers. In other markets, by the way, take India as an example, where exiting through the public markets is probably been the highest source of valuation, and you can exit faster. In India, in the last 3 years, I think we've done now over 15 IPOs. All of them incredibly successful. We've been able to exit our position, but in the U.S., doing IPOs, it takes a long time to exit. So we've been very intentional about how we've thought about how do we want to monetize our portfolio.
So what happens to these private equity funds that are sitting with older and big assets where IPOs are the only exit route and the market's too volatile to get them out there? What happens?
They're going to wait.
What does waiting look like, and how painful is it to wait?
You know, I mean, I think that under the circumstances that we kind of, I guess when you think about our industry, there has been a lot of demand for return of capital, right? I mean, it's probably been too slow overall. If you look at our data, our DPI is industry leading. As a result of that, our LPs are differentiating us, okay? We're being positively selected as a result of our returns and how we've returned capital. So, but the facts are, if you're sitting on a portfolio where you're going to depend on the public markets, you're going to do just that. You're going to depend on the public markets. And right now, the public markets are not going to take you out.
Can I just ask, just to put a bow on all of this, if there's a moment where some funds are experiencing angst, be it overexposure to software, be it lack of DPI, we've seen a lot of consolidation in this industry. You've been part of that. Both a credit manager, Peppertree last year as well. Does this just continue at pace then?
There's no doubt that the trend toward consolidation in our industry is continuing. I think that, you know, the larger getting larger. There's good reason for that. Clients want to consolidate their investing activities among a core group of managers that they can rely on, that they've experienced strong results with, where they're getting the benefits of consolidating their activity across asset classes. If you look at the top 25 managers in the market, the top 25 managers, I think, accounted for 40% of all the capital formation in the market. That's a lot of consolidation. That's a lot of concentration of power in the market in terms of the capital flows. We're in a very we're in a position where and we're in a fortunate position in that because of the way we partner, because of our performance, because of the quality of our businesses, the largest pools of capital in the world are choosing to partner with TPG. And so as a result of that, what our obligation is to continue to provide great performance, but also continue to build out our capabilities so that we can provide them with the types of return streams, the types of interesting opportunities on the investing side that they want across the asset classes. So when you look at our major relationships now, they're investing with us in PE, in credit, in real estate, across all the asset classes. And that trend is going to continue. I think that power is going to continue to consolidate in the industry. Capital is going to continue to concentrate in the industry. So I think that I think it's a certainty that that's the direction of travel.
Thanks again to John Winkelried, the TPG CEO. Coming up, another giant of private capital. Apollo was one of the first to raise the red flag on software. Next, we're going to bring you Jim Zelter, Apollo's president, on how they are viewing disruption now. This is Bloomberg Deals.
I'm Norma Linda. Let's take a look at your midday movers. First up, Glencore CEO Gary Nagle said the world's top miners must get bigger to make their voices heard as commodities and metals become increasingly political. Nagel's comments came after talks between Rio Tinto Group and Glencore failed to create the world's largest miner due to disagreements on valuation. The mining industry has become a political flashpoint as U.S. administrations seek to reduce reliance on China, which dominates metal processing and refining. Elsewhere, Saudi Arabian AI company Humane has invested $3 billion into Elon Musk's XAI, deepening ties between the world's richest man and the kingdom as it pushes to become a global AI powerhouse. The deal makes Humane a significant minority shareholder in XAI, with holdings that will convert into SpaceX shares, giving it a roughly 0.24% ownership in the new company. And finally, Wendy's shares are jumping after Nelson Peltz's Trion Fund Management said its representatives had spoken with potential financing sources, co-investors, and strategic partners regarding potential transactions for Wendy's. This could include acquiring control of the company. Those are your midday movers. I'm Nora Melinda.
Nora, thank you very much. Time now for an alternative view. As software fuels ripple through markets, Apollo says it already cut its exposure to the sector near zero. Jim Zelter, the president of the private capital giant, told Bloomberg Surveillance earlier that the firm had grown increasingly bearish over the risk to software loans.
You need to take a step back in the whole evolution of the role of private credit. And as we've talked about on the show before, the non-investment grade portion, which is really the area where PE sponsors look for financing, that's the area where software tech, healthcare tech is around 40% of the marketplace. And we just used as a principal investor in that area, we had a view that there was a greater degree of potential disruption over time in those business models. There's a tremendous amount of wonderful companies out there, but when we think about equity at the bottom of a levered balance sheet or a levered capital structure, there's just risks that we thought were not prudent for our style of investing.
A view which I'm sure Apollo feels very vindicated over the last 2 weeks. Jim Zelter of Apollo Global Management. Up next, our investor committee is going to be taking a closer look at just that. It is the software sector, a sector which has fallen into a bear market after the recent sell-off. The questions we will ask: where is ripe for investing in the software sector? Will it be PE or otherwise? A lot to discuss. You are watching Bloomberg Deals. Welcome back to Bloomberg Deals. I'm Danny Berger. The sell-off in software stocks has been a major theme to start 2026, especially when it comes to exposure for the sector and BDCs. Let's go to Scarlett Fu, who's been taking a closer look.
Well, Danny, it's been a terrible, horrible, no good, very bad year so far for software companies, their shareholders, and their debt holders. So you look at this chart right here, the purple line is the slide in the S&P 500 software names. And just in the past month, you can see that the group is down almost 20% on persistent concern that AI will disrupt, if not displace them. That decline has dragged down a bunch of the business development companies. These are funds that pull direct loans overseen by Blue Owl in white. You have Ares in blue and Sixth Street in yellow. And here's why. Software has become the most influential part of BDC portfolios. It now represents 20% of their sector exposure. That's the white line, more than any other group. And that is just what the lenders have chosen to disclose. In the world of private credit, lenders have leeway to label companies how they want. So companies that, Danny, you and I would regard as software firms are often classified as something else entirely. Now, the sell-off in software has investors reassessing valuations across the tech industry. More than 15% of U.S. technology leveraged loans are now marked at distressed levels. That is a huge jump from sub 10% at the start of the year. Remember, private equity bought many software companies at elevated earnings multiples in recent years, and now you're seeing a recalibration take place.
That is for certain. Scarlett, thank you very much. And that brings us to this week's Investor Committee, where we debate where to deploy capital and what the most attractive deal targets are. Let's bring in Songyee Yoon, founder and managing partner of Principal Venture Partners, Nenad Milicevic, America's co-leader of TMT at AlixPartners, and Anurag Rana, our very own Bloomberg Intelligence senior tech analyst. Thank you three so much for joining. And I mean, what a month of upheaval it's been. Surely there's some attractiveness in some of the babies being thrown out with the bathwater. Songyee, I'd love to start with you to kick off this investment committee. What are the most attractive targets in software right now?
First of all, thank you so much for having me today. It's a really exciting topic to talk about software. As a venture investor who takes a long-term view, I think there are a lot of exciting opportunities to invest in software that's going to shape and move our society forward. And one of the most compelling ideas that I'm interested in these days is investment in software, which is related with the last mile infrastructure for physical AI. We've been investing a lot in physical AI robotics, but actually the orchestration layer that provides a connectivity and operational software is the one that will enable those physical hardwares, robots, autonomous system, and embodied AI to be deployed reliably in this real world enterprise environment. So I think those kind of last mile software is where a lot of value can be created.
All right, so that makes a lot of sense. AI, physical infrastructure, we know that there's been a big build out, so software attached to that would certainly be attractive. Anurag, what are you looking at? What sectors, subsectors, parts of software do you think are the most attractive right now?
Yeah, when you look at it from a buyout point of view, we are really looking for whether the private equity steps in at these valuations and, start to consolidate some of the spaces. I think the big question is whether they're going to go into the application software space or not, which is disrupted a lot more than some of the other. There are some bright spots such as cybersecurity, which is not seeing the same level of sell-off as compared to application. So we are really looking forward to what private equity does in this market at this point.
Yeah, so cybersecurity, maybe one of those more immune sectors. Nenad, if I could bring it to you, because you spend a lot of time advising both companies and private equity, what are you telling people right now? What's kind of the number one box to check, be it subsector or otherwise, that you think is a very resilient software play right now?
I agree with Anurag's cyber and anything that's security related. That's really where the moat is. The other area where we see a lot of investment with our private equity folks is really vertical SaaS players with regulatory lock-ins. Think health tech. We see a lot of money, private equity is shoving a lot of money into those areas.
So, okay, these are all different flavors of software. So maybe there is more immune than just one thing. Songyee, if I can bring it back to you, because you of course work at Principal Ventures. You're also on the board of HP. So you have experience both on the investing side and the corporate side. The kind of targets you're looking at when it comes to AI infrastructure. You mentioned these are things you're specifically doing at Principal Venture Partners, right? Or would you suggest that companies also look at these types of targets to vertically integrate?
Yeah, I mean, that's a really great question. I think there's a lot of value that can be created from vertically integrated offering, because the companies understand.
Yeah, I can hear you. It's fine.
Sorry, go ahead, Songyee. I think we're just having a little bit of issue with Anurag's audio there. Sorry, please continue.
Right, like specificity of the kind of.
All right, we'll see if we can get that sorted out. Anurag, I think we hear you. I don't know if you hear us, but Songyee, please.
I can hear you.
Okay, perfect. Songyee, please continue.
Yeah, so the vertically integrated software has a lot of opportunity for creating the value, not just by providing solutions, but also understanding, helping the companies to really solve their industry-specific problems. One of the challenge that we see in this space is kind of the speed of adoption of technology, and it's not just a kind of adoption in a passive manner. It's a kind of how to transform these companies to be truly AI native companies that embraces all the tech stack, how we manage the data, how we manage data and integrate the software. So there's a lot of kind of more transformative change management that has to take place in all those companies. And I think the integrated software can partner with these big companies going through this transformation and help them unlock some of the values using this technology.
Nenad, what do you see in terms of companies not even just looking to add this technology, but maybe more consolidation more broadly in software?
Yeah, so you may recall that we came out last year with a very bold statement that there will be mass consolidation in the mid-market software space. So think about all of the SaaS players that are providing productivity and automation tools. That market will be consolidated. And with the new tools that came out on February 5th, we will see a lot of disruption.
Anurag, do you agree with that? Are we going to see a lot of disruption and consolidation among mid-level, mid-cap software names?
I think probably the consolidation or the disruption would be more at the lower end than the mid or the large cap, just because some of these companies, when they are intertwined with some of these software packages into their day-to-day operations, it's not that easy to take that off. So, when we look at somebody like a Claude, I think they're going to make a bigger dent on the smaller size of businesses out there.
I'd love to just get your thoughts on that, on the smaller versus mid-sized businesses.
Yes, small and mid caps, but think about once agents start performing tasks, the moats that a lot of these mid-market companies had, that they had customer captivity, high switching costs, will disappear. Because the humans being in enterprises will care, how do I manage those agents? And agents couldn't care less about all of the nice interfaces that they built over time, which build the customer captivity. You won't need those interfaces anymore.
Songyee, I want to bring you into this because, of course, as running a VC fund, you see a lot of these smaller, earlier stage companies. Who do you think is better placed to tackle some of the disruption? Is it coming from the small end, or is that where all the disruption is happening, and it's the mid-cap companies that maybe have more integrated customers and can weather the storm?
So there is a kind of distinction between small, mid-cap software companies and non-software companies. And I think one of the exciting aspect of all this kind of launch of the agent software and ability to deploy this agent in many different disciplines is smaller companies, mom and pop operations who were not able to benefit from the development of software and cloud and all those technology is now in a position to integrate that kind of the power of software and provide more polished and data-based service to their captive audience and clients. So I think this is a kind of exciting moment because this development of AI and technology and agents will enable them to enable that the small, medium cap companies to incorporate the software with a quality that was only available to handful of big tech companies.
It's an exciting moment, but maybe a little bit less excited if you're either one of the private capital firms that's gotten crushed because of their software exposure or one of the companies themselves, which brings me to just the last point I would love for this investment committee to discuss. Anurag, valuations, they were getting pretty punchy, especially when private equity was jumping in 2021, 2022. In your mind, have valuations for the sector as a whole reset enough?
They are reset enough. Now, the question is whether private equity is going to benefit or capitalize on it. And more importantly, the companies that have a decent amount of balance sheets right now, are they going to go out and buy back a lot of their own shares in order to show some confidence to the investors?
How about you, Nenad? What do you think of valuations now?
I think we will see a shift from subscription-based valuation models, which you could predict. And if you look at all of the agent models, there will be a lot of volatility because if it's outcome-based, it will fluctuate over time. And that will drive even more craziness in the markets.
Songyee, I only got 30 seconds left, but I would love to get the final thought from you on this.
Yeah, in my career, I've seen many fluctuations and adoption of new technology that led to price value kind of valuation resetting. So I think it's one of those cycles, but I think we'll see a lot of the new opportunities coming out of this as well.
It is interesting times we live in. Thank you all so much for discussing software today. That is today's investment committee, Songyee Yoon with Principal Venture Partners, Nenad Milicevic with AlixPartners, and Anurag Rana with Bloomberg Intelligence. Up next on Bloomberg Deals, KKR says risk management is critical in credit markets priced to perfection. Chris Sheldon, KKR's co-head of credit and one of the voices behind that call, joins us next. Stay with us on Deals.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, NVIDIA shares are rising after Meta agreed to deploy millions of the company's processors over the next few years, tightening its relationship with NVIDIA in the AI industry. The rollout will include products based on NVIDIA's current Blackwell generation and the forthcoming Vera Rubin design of AI accelerators. Meta will also use NVIDIA's Grace central processing units in standalone computers. Meanwhile, shares of Palo Alto Networks are falling to the lowest level since April 2025 after the company released a forecast for adjusted earnings that came in weaker than expected. Still, the company expects full-year revenue of $11.28 billion to $11.31 billion. That topped Wall Street estimates of $10.5 billion. And finally, Berkshire Hathaway slashed its holding in Amazon by more than 75% in the fourth quarter, while also building out a stake in the New York Times, Warren Buffett's last new bet as chief executive officer. Those are your midday movers. I'm Nora Melinda.
This is Bloomberg Deals. I'm Danny Berger. Debt bankers are clamoring for a piece of M&A comeback, working on $100 billion of debt tied to leverage buyouts. That, according to a Bloomberg analysis. If you factor in the fight for Warner Brothers, that figure could climb well beyond $10 billion. Joining us now is Bloomberg's Claire Ruckin, who wrote this today and comes to us from London. So, Claire, just how big of a year are we expecting for 2026?
Hi, thanks for having me on. Well, we're expecting quite a big year. If you look at what bankers' predictions were at the end of 2025, they predicted that 2026 could be a record year for deal making. And so far, it's got off to a really, really promising start. Bankers are already working on about $100 billion of buyout financing. So it's looking good.
It's looking good, yet as you report in your story, Claire, it is bankers who are very eager to offload the risk and to offload some of this debt as soon as they can. Why?
Yeah, that's right. I mean, these are bankers that have been focused on refinancings and repricings for the past few years. So they are desperate to do buyout financings, and they've been super competitive to get on these mandates. And that's being competitive with each other, but also being competitive with private credit. And so far, they've won out against private credit, and they're competing when it comes to leverage, when it comes to pricing, when it comes to docs. But however eager they are to compete and win these mandates, they also remember what happened in 2022 after Russia's invasion of Ukraine, after inflation soared and interest rates went up, and they were stuck with billions of buyout debt on their balance sheet that they couldn't get rid of. So whilst they're happy to underwrite new debt now, they're also eager to sell it off as quickly as possible because they don't want that risk sitting on their balance sheet. And so we're seeing a lot of sale processes at the moment.
Yeah, Claire, thank you so much for bringing us this story. Excellent reporting. That's Bloomberg's Claire Ruckin. It is getting, though, costlier to make mistakes in credit markets, with much of that space priced to perfection. That's what KKR warned out in a report today. Joining us now is that report's co-author, Chris Sheldon, partner and co-head of credit and markets at KKR. Chris, thank you so much for joining.
Thanks for having me.
Now, we can discuss a little bit exactly what that phrase price to perfection means in this market. But I first want to, based off of Claire's story, ask what it means for a market when spreads are really tight to get this upswell of M&A supply coming in.
Yeah, it's welcomed. We are living in an environment where spreads are tight, and a big driver of that is the supply and demand imbalance. We haven't had a lot of net new issuance in the market the last few years. And as most of the capital is reinvested back into the market, that interest compounds, particularly as rates are higher. So we are in the supply and demand imbalance where we're welcome of new capital coming in, for sure.
How much would it take for the imbalance to turn into where there's so much supply that it widens spreads significantly?
Look, I think that it takes a lot.
And so like $100 billion from M&A?
Each market's a little different, right? And it depends which market that goes into, whether it be the syndicated loan market, the high yield bond market, the private credit market. whether it's investment grade, asset-based finance, or corporate. So it depends is the quick answer. But you mentioned sort of price to perfection. I do think that the market is at a 50,000-foot level priced to perfection. A big part of it is there's infinite demand or close to infinite demand for high-quality assets. But there's a lot of dispersion in the market, and what people aren't really talking about is there's been dispersion in the market for years now. If you look at the syndicated loan market, for the last 3 years, defaults have been elevated around close to 4%, 3.8% when you throw in LMEs and other restructurings. That's an elevated above level. Now, the high yield bond market has been low default levels, but that's the highest quality high yield bond market we've ever seen. It's 57% double B, and it's the shortest duration market we've seen. So it's comparing that to historical levels may not be the right comparison.
So how difficult is it then to make a mistake if there's still a lot of demand in credit markets overall, the quality of which has been healthy?
Yeah, and it is difficult. You're getting penalized for making mistakes in the public markets. There's definitely the haves and have-nots. And a big part of that is if you look at a lot of the capital that's been raised in the credit markets, it's rules-based capital. What does that mean? It's restrictions on the ratings you can buy, the weighted average spread in a CLO. It's only senior secured. And so what ends up happening is that a lot of flexibility is taken out of the market, or it has to be liquid asset. And so as a result, there's definitely a reaction of sell first, ask questions later when things miss, which creates an opportunity. And I think that's where if you can be flexible, if you can be nimble, if you can have multi-asset approach, that's where you're going to win. And I think avoiding mistakes is also going to be a big part of 26 Alpha.
To that point, do you think that there are a lot of opportunistic loan traders, buyers who are now looking at some of the selling and software names and are jumping in?
For sure. I think there's a lot of overselling in some of these high quality software names. You know, it reminds me a lot of the high yield market in 2015 when 20% of that market was energy and the whole market sold off. You have 20% of the private credit or direct lending market in software. You have 13, 14% of the syndicated loan market in software. So I do think that there is some overselling as a result, and it's not going to be equal, and there's going to be a lot of dispersion by specific credit.
You know, with all the competition for loans, and Claire was talking about it, not just from the broadly syndicate market, but from private credit too. In that competition, there had been a lot of criticism early on in the deal peak of 21 and 22 that a lot of cov-lite deals were getting done, that the quality of some of these loans weren't as good. Is that at risk of repeating as banks come back in full force and then are competing with their private credit counterparts?
Yeah, I don't view the public-private as competition. They are going to coexist together. And right now, with what we've seen in the direct lending market is the size of the business has just gone up. So the cov-lite doesn't necessarily stress us out at KKR that much because the average EBITDA has grown dramatically to what we're lending against. I'd much rather lend against a $250 million EBITDA business than a $25 million EBITDA.
So if you are going to look for possible spots of cracks of concerns, as you laid out in your report, where might you look?
So I think, look, you're always going to focus on where the supply and demand imbalance is out of whack. And there you're seeing a lot of capital formation in the public markets and in addition to the direct lending market. However, I'm not saying walk away from that. If you run that very diversified, keep it high quality, you're still earning 9 to 10% cash on unlevered on a lot of these markets. So that's attractive to us. It's just go up in quality, go diversification. Then focus real opportunity on where the supply and demand is the other way. So that could be regions like Asia. That could be parts of asset-based finance. Or that could be in sort of this capital solutions or structured equity where we're seeing a ton of opportunity and no spread compression.
Chris, thank you so much for bringing us this excellent research. We appreciate your time today. Chris Sheldon, partner and co-head of credit and markets at KKR. Coming up, we discuss the MSG split, a possible split between the Knicks and the Rangers. Will Scarlett be wearing her Rangers jacket? Those questions to be answered after this break. Welcome back to Bloomberg Deals. I am Danny Berger with Scarlett Fu, and we end the hour where we started. MSG Sports Board of Directors approving a plan to explore splitting the Knicks and the Rangers. Your beloved Rangers, I teased it. She's
I
wearing
wear
it.
this every day because it's cold in the office.
Well, so who knows this business better than you, Scarlett? Why would they explore this?
Well, I mean, the enterprise value, which includes debt, is about $9 billion, and that's a significant discount to the value of each team. The Knicks worth almost $10 billion, the Rangers worth more than $3.5 billion. So that's part of it.
But this is already such a complicated beast.
It is. There are already three companies, MSG Sports, which owns the teams, MSG Entertainment, which owns the venues, and Sphere Entertainment, which owns the regional sports network, MSG Network. So now you have sports splitting up even further.
And hopefully it won't impact the Rangers season, right? Like it'll make them even better?
Fingers crossed.
Fingers crossed. All right, you heard it here first. That does it for Bloomberg Deals.